Hello ladies and gentlemen, welcome to my channel. My name is George Kingori. I'm your online finance guy who speaks about all things finance. How you can be able to save, how you can be able to invest, and how you can be able to grow in your financial journey. And today I'm going to speak about 8 beginner investor mistakes you need to avoid. What are the mistakes that beginner investors make, and what can you be able to do to avoid these mistakes? So the first mistake is emotionality when it comes to investment. There are a lot of people who allow emotions to flood them when they are getting into an investment. It could be that you are too happy or too excited about an investment. Remember, excitement and too much happiness over an investment can also cause you to over-exaggerate the expected return on investment. It can cause you to underestimate the available risks on such investments. So remember, when you're too happy about an investment, it might force you to put too much money into that investment and be too optimistic when the reality on the ground may be a little bit different. So ensure that you are not too happy. Again, do not be too fearful, because being too fearful will cause you to, again, over-exaggerate the risks that are involved in these investments. They would cause you to invest a little bit less money than you need to invest so that you can be able to create value. So ensure that you have debunked emotions from any investments, because remember, the people who actually get you, the conmen get you to put your money in investments that do not have head or tail, because they appeal to your emotional state. So keep your emotions away from investments and make decisions that are based on your value judgment, not on emotional investment. Ladies and gentlemen, the other thing is beginner investments sell quickly. When they see, for example, in the stock market, when they see their value is going down, they sell quickly. But remember, you need to understand the dynamics of how a stock market works. And I will link a video on how you can be able to invest and beat the market and create value consistently. Remember, you need to ensure that you do not just sell because of the fear that a share price is going down, but you need to sell when you have made a profit from the share that you initially bought. You need to create to find a way that you have been able to get capital gains. Don't just sell for the fear of the anticipation that prices are going to go much lower. Remember, prices generally in a stock market are going up consistently over a period of time. So don't just sell quickly because of fearing that prices are going much lower, or buying too quickly thinking that they are going to go much quicker now based on some information that you may have got. Make value judgments. Do not sell too quickly or buy too quickly or things like that. Just have value judgment as you come to your sell buy decisions, especially in the stock market. Then the other thing is people are stuck in restrictive investments. You have put your money in investments that do not allow you to move off. You need to ensure that you do not put your money in structured investments that keep you locked in for a long period of time when you cannot have any leeway to be able to move or do such things. There could be such things that are involved with other third parties, and you will need, for example, to sell your shares. Maybe it is a private company. You need to sell your shares to somebody, which might be harder to be able to sell to be able to acquire value. So if it does not make head or tail, do not put your money in investments that will force you to stay there despite your desire or willingness to move out, take advantage of a new opportunity that has come, or do other things. So ensure you do not have these restrictive contracts that are going to keep you stuck there. Then the other thing that you need to do is take advantage of take tax advantages on investments. When beginners start their investments, they are stuck with investments that are not planned in a way to be able to take advantage of the existing tax policies. Because remember, there are tax policies that would allow you to be able to write off depreciation. There are tax investments that will be able to allow you to write off investment deductions. There are tax advantaged investments that will be able to reduce your overall tax liabilities. But beginner investors do not have that in mind as they invest and are charged a lot more tax than more experienced investors who are able to avoid some of these taxes that are levied on these beginner or novice investors. So ensure that you have understood your tax policies, ensure that you have been able to claim all relevant expenses that are accruing to this investment that you are making, and ensure that you're able to structure to avoid a lot of debt in terms of tax liability. Then the other thing is taking loans to be able to invest. A lot of novice investors, due to either their novice nature or their too emotional while they're investing, they take on a lot of debt, especially high interest debt, to be able to take advantage of an investment that may not be able to generate the same value over time. A rule of thumb is this: even a loan is going to charge you, say, 10% rate of interest, then you need to invest in something that is going to generate more than this 10%, so that you can be able to make financial value, so that when you deduct your return on investment from your interest charges, then you have at least a margin. Unless the same investment that you are undertaking has an extremely high capital gains ratio, then you might be able to forsake this rule. But however, if there is no capital gains on this investment, then ensure that you are making more return on investment compared to the interest that you are paying. I'm not saying do not take on debt to invest, but ensure it is calculated debt. A lot of novice investors take on debt to be able to take advantage of an investment opportunity that may not generate the money in return. Remember, your investments need to generate much more than the interest that you are paying towards your loan. When you do not do that, you are losing money. In fact, you just took money to be able to pay somebody and lose value over time. The other thing that you need to do is avoid high fees that are charged, especially by money market funds and hedge funds and things like that. The people who take on your money to invest on your behalf, maybe ETFs and things like that, when they charge you a lot of money, a high percentage of money, and especially when they charge you regardless of whether you are making any value. So there are those people who charge an interest rate, but on the assumption that you're going to make a profit. When you do not make a profit, they do not charge. Those ones are better. However, there are some that are usually much more exorbitant, and they would charge you on your value, regardless of whether there's any value that has been generated from this investment. These are the people that you need to avoid. So ensure that you do not enter into contracts with these third parties that are going to make them make money from you despite you getting any value. So high fees arrangements should be avoided in totality. When you have your rental properties and you put them in with agents, and these agents are acquiring much more money than is necessary, and when they charge you regardless of whether somebody has occupied the property, then you need to avoid these agents. So such things are the kind of investments that people make, especially in their novice state, that have of more financial harm than good. So the other thing that you need to do is ensure that you do not invest in businesses that you do not understand. This is again something that people in their novice state investing in businesses they do not understand. When they do this, they get themselves in a fix because they either make poor decisions or they invest in businesses that are actually overvalued and they are not generating enough money, but it is a trap for them to generate losses. So ensure that you do not get yourself in the trap of a business that is generating losses, but because you do not understand, you have lost your value and you make poor decisions, and it's a whole other roll up of many things that happen that make you lose your value. So only invest in things that are generating value. Then the other thing is investing with friends and family. I'm not saying it is a bad thing to be able to invest with friends and family, but you need to come into that with the mindset of a businessman. Is it making financial value, or am I just benefiting benefiting others by contributing much more money and much more input when the same is not commensurate on my part when I am receiving my return on investments. Or it could be in such a way that it is geared to improve the lives of some and ensure that the others do not benefit. It's like a social scheme that only benefits, say for example, your parents or your siblings, and creates no financial value. If it is such an arrangement, do not call it an investment. Call it a family, social family thing that is based, that is put there to be able to benefit some and not yourself. But when you enter into such and they do not make financial sense to you and you're continuously investing, then it is a loss to your investment, because the capital gains are not going to you, the value is not going to you, but to other third parties that may not contribute to that. Because of the vagueness of such arrangements, I would personally ask you to divest yourself from such things, because you cannot really pull out your value, you cannot really ascertain your value, there is no transparency, and you cannot even push for transparency in such arrangements. And especially because it is your family and friends, you are still also emotionally invested because of all these gray areas, and because of this clarity, and because there are no contracts on things that are set in place, that have obligations, that have ways that you can be able to ascertain your value. Then I would suggest that you as a novice investors avoid such. But people have gotten themselves in such fixes, and that is one of the mistakes that novice investors get themselves into. So I hope that I've been helpful to you. I hope that you will not make these mistakes if you have not invested. And if you have invested, I hope that you have found a way to be able to avoid getting trapped in these financial quagmires. So thank you for coming to my channel. Remember to subscribe to the channel, to like this video, and to leave a comment down below. Thank you and enjoy your day.